The Section 965 transition tax applies to foreign corporations referred to as specified foreign corporations. A specified foreign corporation means any CFC and any foreign corporation with respect to which one or more domestic corporations is a U.S. shareholder. For 2017, a U.S. shareholder is a U.S. person that owns within the meaning of Section 958A or is considered as owning under the constructive ownership rules of Section 958B 10% or more of the voting shares of a foreign corporation. Under Section 958A, stock is considered owned by a person if it is owned directly or if it is owned indirectly through certain foreign entities. Under Section 958B, Section 318 attribution rules apply, with certain modifications, to the extent that the effect is to treat any U.S. person as a U.S. shareholder. Section 318A2 provides rules attributing ownership upward from entities to its owners. Section 318A3 provides rules attributing ownership downward from owners to entities. For example, Section 318A3A provides that stock owned by a partner in a partnership is considered as owned by the partnership. In comparison, Section 318A3C provides that stock owned by a shareholder in a corporation is considered owned by the corporation if 50% or more of the stock in the corporation is owned by the shareholder. Notice 2018-26 provides an example of the attribution rules for purposes of determining whether a foreign corporation is a specified foreign corporation. In the example, person A owns 100% of the stock of a domestic corporation, DC, and 1% of a partnership, PS. A United States citizen, USI, owns 10% of PS and 10% by vote and value of a foreign corporation, FC. The remaining 90% of FC is owned by non-U.S. persons that are unrelated to A, USI, DC, and PS. Absent the application of attribution rules, FC would not be a specified foreign corporation because FC is not a CFC and there would be no domestic corporation that is a U.S. shareholder of FC. Under Section 318A3A, PS would be treated as owning 100% of the stock of DC and 10% of the stock of FC. Under Section 318A5A, the shares of DC and FC are treated as actually owned by PS for purposes of reapplying the attribution rules. Since PS constructively owns 100% of DC, under Section 318A3C, DC is treated as owning the stock owned by PS. This means that DC is treated as owning 10% of FC. Since DC constructively owns 10% of FC, DC would be a U.S. shareholder with respect to FC, causing FC to be a specified foreign corporation. USI is a U.S. shareholder with respect to FC. Thus, absent an exception, USI would be required to include amounts in gross income by reason of Section 965 with respect to FC. Notice 2018-26 provides that the IRS intends to issue regulations providing that, solely for purposes of determining whether a foreign corporation is a specified foreign corporation, stock owned directly or indirectly by or for a partner will not be considered as being owned by a partnership if the partner owns less than 5% of the interests in the partnership's capital and profits. Since person A owns less than 5% of PS will not be attributed the shares of DC, and FC will not be a specified foreign corporation. Let's look at a similar but less complicated structure. USI owns 10% of FC, and the remaining 90% of FC is owned by unrelated parties. USI also owns 50% of DC, a domestic C corporation. Under Section 318A3C, DC is treated as owning the stock owned by USI. This makes DC a U.S. shareholder of FC, and FC is a specified foreign corporation. Thus, USI is required to include amounts in gross income by reason of Section 965 with respect to FC.